Yo, what's up everybody, it's GFR, and we just got some huge news from the Federal Reserve that's gonna directly impact your money. I'm talking about your investments, your savings, even the cost of your groceries. The Fed just announced another rate hike, bumping the federal funds rate by 0.25% in an attempt to fight inflation. But why does this matter to you? Let's break it down. Alright, so the first place we gotta talk about is the stock market. It's the heartbeat of the economy, a place where fortunes are made and lost in the blink of an eye. But what happens when there's a shockwave, a sudden jolt that sends ripples through the entire system? Now, whenever the Fed raises rates, it's like hitting the brakes on the economy. Imagine you're driving a car at full speed, and suddenly you slam on the brakes. Everything inside the car gets jolted forward. That's what happens to the economy when the Fed decides to increase interest rates. See, higher rates mean borrowing money gets more expensive. Whether it's a business looking to expand or a consumer wanting to buy a new home, the cost of borrowing goes up. This can slow down spending and investment, which in turn can cool off economic growth. And when it costs more to borrow, businesses tend to slow down on their expansions. They might delay new projects, cut back on hiring, or even lay off workers. This can have a ripple effect throughout the economy, affecting everything from job growth to consumer spending. They might hire less, and that can impact their earnings. Lower earnings can lead to lower stock prices, which can affect investor confidence and lead to even more selling in the stock market. Now, not all stocks react the same way to this. Different sectors and companies have different levels of sensitivity to interest rate changes. Some might be more resilient, while others could be more vulnerable. Think of it like this: you've got your high-growth companies, especially in tech. These companies often rely heavily on borrowing to fuel their rapid expansion. They need capital to invest in new technologies, hire top talent, and scale their operations. These guys, they rely heavily on borrowing to fuel their rapid expansion. When rates go up, their costs go up, and this can put a squeeze on their profit margins. Investors seeing this might get a little spooked and start selling off their shares. So when rates go up, their costs go up, and investors get a little spooked. This can lead to increased volatility in the stock prices of these high-growth companies, as investors reassess their risk and return expectations. You might see some selling pressure on those high-growth tech stocks. This can create a domino effect, where the selling pressure spreads to other sectors and leads to broader market declines. On the flip side, you've got your more stable, dividend-paying companies like those in the utilities or consumer staples sectors. These companies tend to be less sensitive to interest rate changes because they provide essential goods and services that people need, regardless of economic conditions. These are your classic defensive plays. They offer stability and steady income through dividends, which can be particularly attractive in a rising rate environment. See, people still need to keep the lights on and buy toothpaste, even when the economy slows down a bit. These companies can provide a safe haven for investors looking to weather the storm. Plus, those juicy dividends start to look even more attractive when interest rates are rising. Investors seeking income might flock to these stocks, providing support to their prices. Now, I know some of you might be thinking, Graham, should I be selling everything and hiding out in cash? It's a natural reaction to want to protect your assets in times of uncertainty. And look, I get it. Market volatility can be scary. Seeing the value of your investments fluctuate wildly can be nerve-wracking, especially if you're not sure what's driving the changes. But remember, this is just one data point. The market is influenced by a multitude of factors, and interest rate changes are just one piece of the puzzle. It's important to keep a broader perspective. The market's already priced in a lot of this rate hike anticipation. Investors have been expecting these changes, and much of the impact may already be reflected in current stock prices. What you need to focus on is the long-term fundamentals of your investments. Are the companies you're invested in fundamentally strong? Do they have solid business models, good management, and a competitive edge? Are you diversified across different sectors? Diversification can help spread risk and reduce the impact of any one sector's downturn on your overall portfolio. Do you have a solid investment plan? Having a clear strategy can help you stay focused and avoid making impulsive decisions based on short-term market movements. Are you investing in companies that you believe in for the long haul? Investing in businesses with strong fundamentals and growth potential can provide stability and growth over time. If you answered yes to those questions, then you're in a much better position to weather any short-term storms. Staying focused on your long-term goals can help you navigate through periods of volatility. This isn't the time to panic. Panicking can lead to rash decisions that might hurt your financial future. Instead, take a deep breath and assess your situation calmly. This is the time to be strategic. Review your portfolio, make adjustments if necessary, and ensure that your investments align with your risk tolerance and financial goals. Revisit your portfolio, make sure it aligns with your risk tolerance, and if you're unsure about anything, talk to a financial advisor. Professional guidance can provide valuable insights and help you make informed decisions. Remember, knowledge is power, and the more you understand how these macroeconomic factors impact your investments, the better equipped you'll be to make informed decisions. Stay educated, stay informed, and stay focused on your long-term financial goals. Now let's talk about everyone's favorite volatile asset, Bitcoin. This digital currency has captured the imagination of investors and tech enthusiasts alike, becoming a symbol of financial revolution and a topic of endless debate. Crypto has been on a wild ride these past few years, with dramatic price swings that can make or break fortunes overnight. The volatility is both a feature and a bug, depending on who you ask. And the Fed's decision adds another layer of complexity. The Federal Reserve's policies have far-reaching implications, not just for traditional markets but also for the crypto space. See, Bitcoin and other cryptocurrencies, they've kind of positioned themselves as an inflation hedge, right? The narrative is that in a world where fiat currencies are losing value, Bitcoin's limited supply makes it a safe haven. The idea being that as fiat currencies lose purchasing power, Bitcoin, with its limited supply, will hold its value better. This has attracted a lot of attention, especially in times of economic uncertainty. But here's the thing, Bitcoin is also highly sensitive to changes in risk appetite. When investors are feeling adventurous, they flock to assets like Bitcoin. But when fear sets in, they often retreat to safer investments. When the Fed tightens monetary policy, it can make riskier assets, like crypto, less appealing to investors. Higher interest rates mean better returns on safer investments, which can draw money away from the crypto market. Why? Because when you can get a decent return on a safer asset like bonds, the appeal of something as volatile as Bitcoin can diminish. Investors start to weigh the risks and rewards differently. So, what does this mean for the price of Bitcoin? Honestly, it's anyone's guess. The market is influenced by a myriad of factors, making it incredibly difficult to predict with any certainty. Crypto is notoriously difficult to predict, and there are a lot of other factors at play here like regulation, adoption rates, and even Elon Musk's tweets. Each of these elements can send shockwaves through the market. But here's what I'm watching closely: the immediate market reaction to the Fed's rate hike. This will give us a clue about investor sentiment and how resilient Bitcoin is in the face of tightening monetary policy. First, how does Bitcoin react to this rate hike in the short term? Does it sell off sharply, or does it hold its ground? The initial reaction can set the tone for the coming weeks. Does it sell off sharply, or does it hold its ground? A sharp sell-off could indicate a lack of confidence, while stability might suggest that investors are still bullish on Bitcoin's long-term prospects. Second, what does the Fed say about its plans for future rate hikes? The more aggressive the Fed is, the more pressure it could put on risk assets like Bitcoin. Investors will be parsing every word for clues. The more aggressive the Fed is, the more pressure it could put on risk assets like Bitcoin. A hawkish stance could lead to more volatility in the crypto market. And finally, keep an eye on any regulatory developments. Governments around the world are starting to take notice of the crypto market, and we could see some major regulatory changes in the coming months and years. Governments around the world are starting to take notice of the crypto market, and we could see some major regulatory changes in the coming months and years. These changes could have a significant impact on the price of Bitcoin and other cryptocurrencies. These changes could have a significant impact on the price of Bitcoin and other cryptocurrencies. Regulatory clarity could either boost confidence or create new hurdles for the market. So, if you're invested in crypto, buckle up because it's going to be a bumpy ride. The landscape is constantly evolving, and staying informed is crucial. Make sure you're only investing what you can afford to lose, and have a plan for how you'll react to different market conditions. Diversification and risk management are key to navigating this volatile market. Okay, so we've talked about stocks and crypto, but how is this rate hike going to impact your everyday life? It's not just about numbers on a screen, it's about real-world consequences that affect your wallet and your peace of mind. Well, get ready to feel the pinch in a few key areas. First up, mortgages. If you're thinking about buying a house, this rate hike just made it more expensive. And it's not just new buyers who are affected. Existing homeowners with adjustable rate mortgages are also in for a shock. Mortgage rates tend to follow the 10-year Treasury yield, which is influenced by the Fed's actions. So, those dream homes just got a little further out of reach for some. And if you've got an adjustable rate mortgage, your monthly payments are probably going up. This means you'll have less disposable income for other necessities and luxuries. So, those dream homes just got a little further out of reach for some. And if you've got an adjustable rate mortgage, your monthly payments are probably going up. That means less money in your pocket for everything else. Next, let's talk about credit card debt. Most credit cards have variable interest rates, meaning they go up when the Fed raises rates. So, if you're carrying a balance, expect to pay more in interest charges. That means less money in your pocket for everything else. And if you're already struggling to make ends meet, this can be a significant burden. My advice? Pay down that high-interest debt as quickly as possible. Car loans are another area where you'll see the impact. Just like mortgages, auto loan rates are also affected by the Fed's moves. So if you're in the market for a new car, be prepared to pay a higher interest rate on your loan. And don't even get me started on inflation. The Fed's trying to combat rising prices, but in the short term, we might actually see inflation stay stubbornly high. That means your grocery bill, your gas bill, everything's going to keep costing more. So, if you're carrying a balance, expect to pay more in interest charges. My advice? Pay down that high-interest debt as quickly as possible. Car loans are another area where you'll see the impact. Just like mortgages, auto loan rates are also affected by the Fed's moves. So, if you're in the market for a new car, be prepared to pay a higher interest rate on your loan. And don't even get me started on inflation. The Fed's trying to combat rising prices. But in the short term, we might actually see inflation stay stubbornly high. That means your grocery bill, your gas bill, everything's going to keep costing more. And don't even get me started on inflation. The Fed's trying to combat rising prices, but in the short term, we might actually see inflation stay stubbornly high. That means your grocery bill, your gas bill, everything's going to keep costing more. Look, I know it's frustrating. It feels like we're getting squeezed from all sides. But here's the thing, burying your head in the sand won't help. You've got to be proactive with your money. And don't even get me started on inflation. The Fed's trying to combat rising prices, but in the short term, we might actually see inflation stay stubbornly high. That means your grocery bill, your gas bill, everything's going to keep costing more. That means your grocery bill, your gas bill, everything's going to keep costing more. Look, I know it's frustrating. It feels like we're getting squeezed from all sides. But here's the thing, burying your head in the sand won't help. You've got to be proactive with your money. That means your grocery bill, your gas bill, everything's going to keep costing more. Look, I know it's frustrating. It feels like we're getting squeezed from all sides. But here's the thing, burying your head in the sand won't help. You've got to be proactive with your money. Look, I know it's frustrating. It feels like we're getting squeezed from all sides. But here's the thing, burying your head in the sand won't help. You've got to be proactive with your money. It feels like we're getting squeezed from all sides. But here's the thing, burying your head in the sand won't help. You've got to be proactive with your money. But here's the thing, burying your head in the sand won't help. You've got to be proactive with your money. You've got to be proactive with your money. So what can you do to navigate this new financial landscape? So what should you do? Investors, now's the time to review your portfolio and make sure you're comfortable with your risk allocation. Consider diversifying into more value-oriented sectors that tend to perform better in a rising rate environment. Savers shop around for high-yield savings accounts and CDs. With interest rates on the rise, you can finally earn a decent return on your cash. Entrepreneurs, if you're thinking about taking out a loan for your business, now might be the time to lock in a rate before they climb even higher. Pro tip, the stock market is a device for transferring money from the impatient to the patient. Warren Buffett. Not everyone agrees. Bulls say this rate hike is a sign of a strong economy, but bears argue it could stifle growth and lead to a recession. My take? The economy is a complex beast and it's impossible to predict the future with certainty. If you learned something new, smash that like button. It helps others find this video. Subscribe and hit the bell for weekly breakdowns. Now, I want to hear from you. Are you changing your investment strategy in response to the Fed's rate hike? Comment below. Subscribe now. Watch next 5 high-yield savings accounts, crushing inflation.